Good morning and welcome to the CT Private Equity Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Fund Manager Hamish Mayer. Good morning to you, sir.
Good morning, everybody, and welcome to this third quarter results presentation for CT Private Equity Trust. I'm going to take you through a number of slides covering developments in the last quarter and the year to date, and we should have some time for questions at the end of that. So just looking quickly at the executive summary for the third quarter. So we have recorded a positive return in the third quarter of 3.3%, which means that for the first 9 months of the year, we're up 0.9%. Now, that doesn't sound like a huge amount, but considering that we have had a number of very strong years, we had always expected a quieter year this year. That said, it's not unusual by this stage in the year to have quite a small return, with the final quarter typically being a more significant quarter in terms of overall return. But the good news is that we are positive. We're going through what I would term a bit of a year of adjustment after some very strong increases in NAV, strong realizations, and quite a lot of underlying activity. There's still plenty of activity, but it's moderated a bit from the peak levels of the last couple of years. We are still making plenty of new investments. We invested 24 million in the third quarter. We're also harvesting a number as well, 14 million realizations in the third quarter. Now, this is a very similar number to what was achieved in the second quarter. We'll come on to this in a minute, but we are running about 30% down in terms of exits compared to last year, which was a very strong year. So that is not in itself particularly surprising, and it's not a bad thing. We're still running at a significantly higher level than was achieved in the years prior to COVID. So pretty healthy two-way activity. We've announced a dividend of 7.01 pence, which is the same as was paid at the end of October, but that will be paid at the end of January. Just to remind you that the dividend is paid at 1% of the average of the previous 4 quarters NAV, and if that calculation leads to a number which is below the last dividend paid, we maintain the last dividend. So in other words, the dividend is on an upwards only trajectory, and it follows the long-term growth of the NAV. This dividend has been in place for well over a decade. It's a substantial dividend, it's highly predictable, and it has grown in line with NAV. At the current level of the share price, this is actually a very substantial yield. It's just under 6%. And you obviously get capital gain on top of that income. We're currently standing at 45.4% of the portfolio invested in co-investments, so that's directly into private companies. The aim is to be around about 50%. It takes time to get there because as we make investments, we're also selling investments, so it's been gradually creeping up. But we're on track to get to 50% or thereabouts. Doesn't matter if it's slightly more or slightly less. We're trying to achieve a balance between the fund element of the portfolio and the co-investment element of the portfolio. So we made 5 new investments in the third quarter of this year, 3 fund positions and 2 co-investments. On the fund positions, we invested $5 million into the US fund Purpose Brands. Now, what they do is invest into consumer franchises, a range of different types of company. They basically invest in things like yoga companies, franchises for yoga. They invest in other things where they're basically training children with the sort of, it's like a kind of crammer for children. They do pet type things, sort of doggy daycare and various other types of consumer franchise. Most of them are originating in the US. There's another one where they actually people go and get cooled down in a sort of cryotherapy. So they basically identify these various trends and they invest into these franchises across North America. It sounds quite interesting, and it actually is, and it's demonstrated really good growth. The second one is TorQuest 6. This is a more conventional mid-market buyout fund in Canada. It's one of the leading mid-market buyout funds in Canada, run by a chap called Brent Beltzberg, who I've met a number of times and who is one of the leading figures within Canadian private equity. We've committed 10 million Canadian, which is about 6 million sterling. And then lastly, we've put 10 million pounds into the Inflection Partnership 3 fund. Inflection are basically the leading mid-market buyout company in the UK. They also do minority investment as well as majority investment, and this is the third fund in that area where they are, equally as strong as they are in majority buyouts. So just backing that relationship, it's an important relationship to us, Inflection. Excuse me. 2 co-investments. First one is an Internet of Things software company. I haven't got the name here, and there's a reason for that, because the deal has not yet been publicly disclosed. But what it does is it provides software for industrial machinery, which allows people to operate the factories more efficiently. It's a very large blue chip customer base. It's based in a town in the middle of a country that is quite close to the UK, but on the other side of the channel. And the deal itself is led by Scottish Equity Partners, whom we have been backing in various funds and co-investments since 1996. And then the second co-investment is Utamaco, which is a cybersecurity and data intelligence company. What they do is provide tamper-proof tokens and various other types of security for critical infrastructure. It's a German company. That is a sector that is growing quite strongly, and they have a strong market position within it. This is the long-term progression of the NAV with the cumulative dividends in the light blue. We continue to be on an upward trajectory, as I mentioned, and you can see the share price total return and the NAV total return. There's obviously a gap at the moment because the discount is relatively wide, but the long-term picture is that gap will close itself. We expect that to happen at some point. And this is just another way of looking at the same information. We're on a rising trend. We've had a number of strong years recently. This year is obviously not over. We've just had the first 9 months of it, and so we're optimistic of further progress this year. In terms of outstanding commitments and net asset value, people like to track this. The short summary is that commitments are pretty normal, very close to the long-term average at just over 40% of net assets, 215 million, but 27 million of that is to funds where the investment period has expired, and therefore little of that will actually be drawn. Net debt analysis, the debt has gone up a bit, 74.5 million, but it's still within the comfortable range. We are in discussions with our bank to extend our borrowing facility. It doesn't actually expire until the middle of next year, but we typically arrange for it to be extended well before the expiry date, and we expect to achieve that quite soon. I think all the discussions we've had so far are very positive and constructive, so it's just a matter of following through their internal processes, which we're in the process of doing now. So we've got plenty of headroom to take advantage of opportunities as they arise. We do believe in the benefits of gearing. We've got a very well diversified portfolio, which gives us a good platform against which to borrow. And we expect that the returns that we make from investment will be far in excess of the cost of borrowing. And that remains the case, even though borrowing costs have gone up significantly in the last year or so. This is the list of new investments through 2023 so far. I'm not going to talk about all of them individually, but you can see that there's a wide variety of different companies, different geographies, and different lead managers, thus maintaining the diversification that we aim for, but also giving us the opportunity of making excellent returns through these particular investments. And that has, continues on right the way through. I've got a few slides on the more recent co-investments. I will literally give a couple of sentences on each. There's more detail on the slides that you can consult at your leisure. The first one here is Asbury Carbons. This is a graphite company that mills graphite into special flakes, and there's a very wide range of industrial applications for that. This is an old family-controlled company that's been acquired by Millrock Capital, where the business is substantial and it's got a lot of potential, but it's probably been a bit undermanaged. And Millrock have bought in at 5.5 times EBITDA, which is a very attractive price for this scale of business. And they have a transformation plan which they're in the midst of implementing, and we expect to make a good handsome return here over the next few years. Excuse me. The next one is Star Track. This is led by August Equity, a long-standing partner of ours, and we've been investing with for the best part of 20 years. Star Track is a software company. It provides software for speed cameras, catch people who've been speeding. I had a few qualms about making this investment because I do think they can be a bit overzealous with these things, but I got over those qualms and we made the investment, and it actually is a very big contributor to increasing road safety and catching the bad guys. And basically the technology not only allows the processing of the speeding tickets quickly and efficiently, but it also can detect people that are using their mobile phone whilst driving, which is obviously an offence. It is used by most of the police forces in England and Wales, and the ones that don't currently use it will start using it. And there's more capability that's being added to the software. It's got a small amount of international business, which they're going to grow substantially over the years. So there's a good prospects here. Next one is another software company, also led by August Equity, One Touch. This provides software to the care industry. So both the care companies who can plan their rotas and monitor their care plans and monitor the timing and billing and all that sort of thing, but also the customers, the clients and their families have an app that they can see who's coming in to see their relative and when and what are they actually doing and all that sort of thing. Sounds all very sort of commonsensical, but nobody has actually done such an integrated app before. And this company started in Ireland. It's moved into the UK. It's growing quite significantly. There is a real need for this type of thing, and I think they've got good growth trajectory in front of them. Next one is Cardo Group. So what they do is they refurbish mainly social housing by making them more energy efficient, putting insulation in, putting heat pumps in, various other things like that, different types of heaters. And this company started in Wales. It's led by a young, very impressive entrepreneur who is moving the business into the neighbouring counties in England. A lot of this spend is underpinned by government money, making sure that the social housing sector is as sustainable, and there's a lot of money going into that. Obviously, there are key criteria which have to be met in order to get contracts from the social housing sector, but Cardo know what they're doing, and they will grow quite well over the next few years. Cyclomedia, a completely different company. Again, this is based in the Netherlands. It's basically a system where they map towns and cities. They produce these maps of the property, which are then used by local authorities generally for the purposes of taxation. That car there, they drive around that car, and it has a sort of laser imaging device on top, which basically maps everything as they drive past it, and then they produce these intricate maps, which then allow the local authorities to work out how much they should charge people and the rates and things like that. Started in the Netherlands, it's been moved into the neighboring countries like Germany and France, now into the USA. We've known this company for a number of years. Volpe invested some years ago, and it's now been offered as a co-investment for the next stage in its growth. So that's looking pretty good, actually. And then Utamaco, which I mentioned earlier, is this cybersecurity company, provides various pieces of hardware and software which allow businesses to make their products as secure as possible. For obvious reasons, that is a strong growth market, but they already have a significant share. They've got between 5 and 10% global market share, and it is growing quite nicely in the sort of low teens. German company. Germans are good at engineering, as you all know, and this is growing very nicely. So these are the realizations so far this year. I'm not going to talk about them individually, but you can see the outcomes are good on the right-hand side, good money multiples and IRRs. There are occasionally ones which aren't so good, but for example, at the bottom, PD and MS, which is an inflection exit, 1.1 times 1%, doesn't look that exciting. But bearing in mind that that company was once held at 0.1 times, it's a pretty good outcome. There's plenty of others which have got IRRs up in the 20s and 30s and well beyond that. Different types of company, transvective reagents for gene therapy on the one hand, wine drums, logistics providers on the other. So deliberately, we create a deliberately well diversified portfolio, and that means that you can have exits taking place all the time because there's always somebody wanting to get involved in these high growth businesses, and that has continued well throughout this year. We've also been redeploying the money back into new investments. I've talked about the recent co-investments, but there's several others that happened earlier in the year, and they're summarized here. And that continues all the way through. A lot of these businesses have got quite a strong technology slant to them. And that is, because we see good long-term secular growth there, and so do our private equity partners who are putting the deals together. This is a long-term picture of distributions and drawdowns. Obviously, it does fluctuate. There is a cycle to things, and we've had quite an active period in recent years. We're going through a slightly less active period now. That's entirely to be expected. This is not a slump, very far from it. It's just a sort of slower period, and that will be followed by a more active period fairly soon, I think. On the largest underlying holdings, just a couple of things to highlight. Sigma, the electrical components company, the lead on that Argand are trying to sell this. It will probably be sold later next year. Coretrax, wellbore cleanup company led by Buckthorn. We expect that will be exited in the first half of next year. Jolly's is also in a sale process. And TWMA will probably sell later next year. So that's the top four. There's a good chance that this time next year, none of those will be in the portfolio. Aurora is a more recent investment, so that's still growing quite well. San Siro is the sort of residual position from that holding, which we sold 3/4 of last year and made 9 times our money. That's going fine. ATEC is an insurance company that provides insurance for sort of caravans and boats and things. That is also they're also exploring exit options there. Amethyst Radiotherapy is still growing. Cyclomedia, I've just mentioned, has just gone into the portfolio. And Accuvane has been in the portfolio for a while. It's still got a bit of progress to make before it becomes a immediate sale candidate, but it is growing quite well. So quite a few things to watch out for there. And when we have realizations, it does tend to drive NAV growth because typically they are exiting at a good premium to the latest carrying value. The portfolio is well diversified by geography. The largest element is in the UK market. No surprise there. That is our market. It's also the largest private equity market in Europe by some way. We have most of the rest of the portfolio is invested in continental Europe, but there is a significant amount, 17% in the USA. That's always been the case. We have got a range of strong connections there, and we have continued to back our partners there where they continue to succeed. The vintage of the portfolio, it's well seasoned, so 60% is over 3 years old, 50% over 4 years old. The typical investment is structured over a 4 or 5 year holding period. So when you get into the 3 or 4 year zone, you're starting to plan exit. So the reason we monitor this element is it's a good proxy for the maturing part of the portfolio from which the exits will be derived in the near term. If we had a very small amount of mature investments, then you would see corresponding with small amount of realizations. But we invest every year in order to maintain that seasoning, if you like, in the portfolio. In terms of the valuation, it's not particularly high compared to our peer group. It's only 11.6 times an enterprise value to EBITDA, which is basically a pretty stable kind of number over recent quarters. It's at the sort of higher end of normal if you look over the long term, but it's not particularly stretched. And the enterprise value to EBITDA entry value 8.7 times is slightly above the long-term average, but only slightly. In terms of debt to EBITDA, it's 3.1 times. This is quite modest gearing. I mean, all these deals are geared. Most of them are, well, almost all of them are geared, but they start paying down debt once the deal starts. And so, we're not particularly highly geared. And hence, although interest rates have gone up, there isn't immediate sort of strain across the portfolio. I mean, there are 1 or 2 instances, but literally 1 or 2. And so we're not particularly vulnerable to higher interest rates. This is the exposure by sector. You can see that information technology and healthcare are big sectors for us. I think it's about 45% if you add those two together. I mentioned earlier about the secular growth in these areas, the digitalization of society, the use of software more and more, but also healthcare, new equipment, new treatments, growing. Quite often they themselves actually will have a software component to them. And this has been a long-term feature in this portfolio to have significant exposure in these two sectors. I don't make any apology for that. These are where our investment partners see best long-term growth. And if they can capture that at a reasonable price, then we should make excellent returns. We've also got a bit of consumer, business services, industrials, consumer discretionary. It's an area that's been under more pressure. I mean, it's not crisis stricken or anything like that, but there's a bit more pressure there, for obvious reasons with sluggish economic growth. But most of these businesses are proving to be quite resilient. Which brings me to the conclusion, where I've mentioned resilience here. I mean, that's deliberate. We are not seeing wide-scale deterioration of fundamentals. Quite the opposite. The fundamentals, the underlying companies remain good. They have sort of all come through COVID very, very well. They're dealing with all the other shocks. And, we're up year to date, and I wouldn't be surprised if we were up further in the final quarter of the year. We've talked about the strong exposure in information technology and healthcare, which, that growth trend that we see there isn't going to reverse itself anytime soon. And given the long-term nature of our investment horizon, then we will continue to build value there. There's plenty of deal flow, new funds and co-investments. It's excellent. We just have to be selective. We can't do everything. We obviously, in terms of co-investing, we're probably doing about 10% of the sort of proper deals that we're shown. And there's still good value to be found in the lower mid-market. And we've seen some moderation in pricing, which is good from an investment point of view. And we will selectively take those opportunities to lay the foundation for future asset growth. Realizations are down a bit on last year. They're at about 70% of 2022 levels, but they're up on the pre-COVID period. The exits are being achieved at good premiums to previous carrying values. So far in 2023, it's about 30%. It's a bit below the level in 2022, but only just, and probably not a statistically significant reduction. So as things are sold, so it will boost NAV, and we will get some more exits, I think, between now and the year end. And because of all that, we expect that we will continue to grow value for shareholders over the medium and longer term. There are a couple of appendices in here which just show the discount over the last 5 years or so, and the returns versus the peer group. So essentially, we do well compared to our peer group in terms of returns and discount. So I'm now going to stop and basically answer some of the questions.
Perfect. Hamish, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. Just while Hamish takes a few moments to review those questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Hamish, as you can see, we've received a number of questions throughout today's presentation. If I could just ask you to read out those questions and give responses where it is appropriate to do so, I'll pick up from you at the end.
Okay, somebody's asked, what is your view on the FCA consultation on private assets valuation? Do you think closer supervision is required? The answer to that is that we're already pretty closely supervised. The valuation here is a director's valuation. There's an independent board of directors that approves the valuation. But before I can even show it to the directors, we have to go through an internal committee, which is called the Valuation and Pricing Committee, which is composed of senior people within my organization who are not involved directly in private equity, or they're not in the private equity chain of command, if you like, which gives them independence. And they provide a lot of scrutiny over the valuations. The valuations are compiled according to something called the International Private Equity Valuation Guidelines, or their equivalent, because that doesn't actually pertain in North America, although they do have an equivalent system there. And it's a naturally conservative methodology. Now, we can prove this because when exits take place, they are almost always at a significant premium to the most recent carrying value. And this isn't just something that happens occasionally. It happens all the time. I mean, we I think looked at the last 149 exits, and it was over 300 million worth of proceeds. It's in our RNS statement, and that was a premium to the latest carrying value of well over 30% on average. So the idea that the valuations are somehow too high is just not borne out by any of the evidence. In fact, you can argue that the valuations are too low, and given that we tend to sit on a big discount to asset value, well, a significant discount, we're at the higher end of the normal range at the moment. You can argue there's a double discount. So I would say that we are subject to quite a close degree of supervision. I think what the FCA and others would have to say is we'll have to explain to us what case is there to answer before they conclude on this. So that's one thing. Now that somebody else said, interested to hear how much cash in reserve the trust holds and how that compares to the expected dividend payout. Also, what are your thoughts on economic downturn and exit strategies options for underlying funds worsening and therefore distributions paid to the fund, paid to the trust drying up? So we don't hold cash in reserve because we think that you as shareholders would like us to invest the money. You can hold the cash in the building society or a bank account yourself. So when you give us money, it's our job to invest it for you and make the portfolio efficiently invested. We do make sure that we have enough capacity either through cash or borrowing facilities to meet commitments as they are drawn down, and we manage that carefully. There's a big spreadsheet that allows us to do this. We have done this successfully since 1999. I've been involved all the way through. We're celebrating our 25th anniversary next spring. There will be some events which hopefully many of you will be involved in. So we run this so that we don't run out of money, and importantly, we run it so that we can always pay the dividend. That is a very high priority for us. Economic downturn, yes, we're in a sort of more sluggish period. Obviously, we're not actually in recession, despite this recession being much heralded. It still hasn't actually materialized in the UK, although one or two of the European countries are technically in recession. That makes it harder to make money, but it doesn't make it impossible. It makes it harder to achieve exits, but exits are still being achieved. Even if you go back to the very worst situation that I've seen in my career, which was in the great financial crisis in about 2009, people were still selling companies and still buying companies. It never dries up completely. We've obviously got to keep an eye on that. Distributions do not dry up completely. The one thing we can control quite carefully is how much money we spend on new investments, particularly co-investments. And so we do moderate that when we think that the realizations are turning out to be below where we originally expected. So the short answer is, trust us to manage your money carefully, and we will not run out of money. Somebody asks that we state that Inflection is a European mid-market minority buyout fund. It says, how are the minority buyouts different from the majority buyouts apart from the ownership stake? Are the economics different? Is it not better to have majority stakes so the manager can control the management of the company? Yeah, that last comment is generally correct. But when Inflection invest as a minority, they typically have many of the rights of control that you would achieve if you were making a majority investment. So they will have a shareholders agreement that will allow them to have a considerable say on things like exit, timing of exit. So the minority investing is not that different from majority investing. What it does do is it does open up quite a lot more opportunities for them to invest, because a lot of company owners will be deterred from bringing in a private equity firm if they think they're going to be completely in control. But the reality is that the private equity firms often bring lots of extra strengths to that business, and so it makes a lot of sense. The proof is in the pudding. If Inflection can invest as a minority and still achieve good exits within a reasonable time frame and make similar returns, then it's worth doing. And that is exactly what has happened. So they've proven that their abilities in majority investing, the skills they've developed there, are applicable in minority investing. And so that's why we've backed them there. Somebody's asked whether Star Trek, does it benefit from ULEZ? And they've said, just kidding. Well, I'm not 100% sure about that, but it probably does, which is another sort of ethical quandary for us. But there you go. Somebody has said, what impact does Mr. Mayor think a large Labour majority in the UK next year will have on the company's investment process? So this is obviously somebody who thinks he can predict the future in terms of the electoral cycle. I think we're about probably a year away from a general election. The Labour Party, I think, if they win the election, would be sort of well advised to try and sort of make sure that the private equity sector actually is healthy, and it's a big success story for the UK. I know that there's quite a lot of lobbying has been taken place trying to explain to Rachel Reeve and others the benefits of private equity, and that they shouldn't just be viewed as a potential source of tax income, because if they do too much of that, then they will drive a section of the business overseas, and that is exactly what will happen if they follow through on some of their the more aggressive of their tax proposals. I think private equity has built up in Britain over the last several decades over governments of different persuasions. It has proved itself resilient through all sorts of different challenges, and I expect it will continue to prove resilient no matter what happens. Somebody's asked, the entry multiple for Cardo is very low. Well, it's growing very rapidly. It was sourced by Buckthorn, have been working on this business for a long time, and they basically have negotiated an excellent deal there. I mean, it's because it's growing very rapidly. The actual multiple looks, very low, but that is a good thing. Basically, it's down to the skill of Buckthorn. Somebody's asked, what is the average revenue and the average EBITDA growth of the portfolio? Now, we don't have the numbers for this year yet, but last year it was EBITDA growth, I think, was about 22%, and revenue growth was a bit more than that. So there was a little bit of margin contraction. I don't know what it will be for this year, but I think it will still be pretty handsome, actually. Mid-teens and above, I would be expected. I would expect. Somebody said, conscious of the key man risks surrounding Hamish's management of the trust. Any comment on how this is being managed or planned with the team? Well, this is not a one-man band. Obviously, I do lead the team, but I have 9 people in my team, including several directors. They're all directly or indirectly involved in the trust. So, I am 57. I'm not going to do this forever, but I will do it for a few more years. And there are plenty of people more than capable of taking over from me in due course. So obviously my superiors within Columbia Threadneedle do discuss this kind of thing with me. So I think the shareholders need to be confident that whatever happens, this company will continue to be managed successfully in the way that it has been for the last 25 years. Somebody's asked, has anything changed day to day since your manager has been taken over by Columbia Threadneedle? No, because we run a largely autonomous business within Columbia Threadneedle in the same way that we did within the Bank of Montreal, and before that F&C. So in terms of the day-to-day way that we make investments, there has been no change. There are obviously new systems and things that we have to become familiar with within Columbia Threadneedle, we've got a different owner, but that doesn't really affect the day-to-day management. Somebody's asked what proportion of the portfolio is the EV to EBITDA valuation of 11.6 times calculated. I don't have the exact percentage, but it's most of the portfolio, and it includes both fund and co-investments. It's the vast majority of the portfolio. What else? Somebody's asked how Sigma's carrying value derived as shown on the slide. Well, it's a multiple of earnings. I haven't got the exact multiple in front of me, but it's a fairly straightforward way of calculating it. Somebody said some of your peers have been highlighting the opportunity in secondary funds and manager-led secondaries at the moment. Secondaries are only 0.1% of the portfolio. Would you expect this to grow over time? Well, I mean, we basically do take part in secondaries. We have 2 secondaries funds, and these are generally looking in the lower mid-market. It depends how you classify secondary. Some people call what we would describe as co-investments also secondaries. So we're probably understating our exposure to secondaries. There are good opportunities in secondaries. It does fluctuate a bit. We basically have a high threshold return, which we have to be confident can be achieved before we do a secondary. It's the same as for co-investments. It's a 25% net IRR, which means that we're quite often outbid by bigger secondaries funds, but when we do deal, we tend to make good returns. So our long-term returns from secondaries as a business are good. They're in the high 20s. They're very similar to the returns that we achieve from co-investments. So the answer is where we can find a secondary that actually fits the portfolio and it meets the return criteria, it will go into the portfolio. We don't have a specific arbitrary target. And the final bit of the question is, would you expect this proportion to grow over time? And the answer to that is yes. Somebody's mentioned, you mentioned that exits drive NAV growth of the trust. How much of the NAV growth is normally driven by exits in percentage terms? Now, it does vary from year to year, but I would say the way to look at it is the exit premium, if you like, over carrying value is typically a significant minority of the NAV growth in any given year. So there is a good correlation. It's not a perfect correlation, but there's a good correlation between the size and proportion of exits and NAV growth. In other words, if we're having a strong exit experience, then we're likely to have good NAV growth. The converse is not always true, so you can actually get any good NAV growth where exits are more modest, but in general, lots of exits is good for NAV growth. Someone said, any comments on the pre-2014 investments still held? Well, there's a tail, always will be a tail. The ones that show up in the table there mean they've still got value, so they will probably be sold, and we'll get some money back for them. If they didn't have value, they wouldn't show up in the tail. Yeah, somebody says, Thomas B, he said, how does your due diligence process differ for co-investments to primary investments? Do you have enough resources to keep track of co-investments? Well, we certainly have enough resources to keep track of co-investments. We're not leading these deals, but we do very detailed due diligence before we invest. We meet the companies, we meet the lead managers. We have access to all the information that the lead managers have. In about a third of the situations, we're observers on the board of the companies. We've got about 50 co-investments at any given point in time. And with my team of 9 people, that is a viable number. I couldn't run with 50 direct investments with a team of that size, but obviously we're investing in partnership and alongside the lead managers, and we have done over 100 co-investments since 2003. We've sold more than half of them. The returns are excellent. They're in the high 20s in terms of IRR. So I think our system is working pretty well. Somebody said, what would you say is your competitive advantage compared to Pantheon or Harbourvest with much larger teams and larger AUM? Well, if you look at their portfolios, they are very, very diverse, literally thousands of underlying companies instead of hundreds. So you're getting in each of these funds, it's more of a buy the market approach, whereas we are more concentrated, albeit we maintain substantial diversification. We are more UK oriented than either of them. We're also more lower mid market oriented, and we also favor so-called emerging managers, which has been a good strategy for us over the last 20 years. So these are key differentiating features, which I think do give us a competitive advantage. If you look at long-term returns, they are at or better than either of those funds. What else? Do I have an aim for where you expect the share price to be in the future? Well, it depends how far into the future. I mean, the NAV is roughly £7, so I'd like the share price to be well over £7 at some point within the reasonably near future. I think in the short term, getting back above £5, I think, is a very achievable objective. And then, move on up £6, £7, £8. We've managed this on a long-term basis. I mean, it's doubling every 4 or 5 years. So I think that's a decent aim to look at. Somebody's asked whether we should convert to a long-term asset fund. We're not considering that at the moment. In many respects, the long-term asset funds are effectively trying to achieve many of the things that investment trusts already achieve. There's an element of reinvention of the wheel going on here. So, and I don't think that would lead to the removal of the discount. Just turning it into a long-term asset fund would not immediately remove the discount. I mean, long-term asset funds will probably not be very liquid. They'll have some sort of liquidity, but they won't be anywhere near as liquid as a investment trust with a diverse shareholder base, market makers, brokers covering it. So I don't think that is something that's on the horizon. Somebody said, how many years will the trust carry on for? Will there ever be a winding up vote, especially as the NAV is over 680 with a share price of 460? Well, it's a permanent capital vehicle, so it doesn't have a continuation vote. And nobody's ever asked for a continuation vote. We run it on a permanent basis. Now, clearly, we want the share price to be more reflective of the net asset value. The best way to do that is for me to create new buyers, to explain what we're doing, to encourage people to buy in. There's a brilliant opportunity to buy in at the moment when you've got such a substantial discount. We are not going to put the company into run off or anything like that. That isn't what our shareholders want. We're providing a good combination of strong capital growth plus a very handsome and growing dividend. It provides a brilliant opportunity for people who would otherwise not be able to become involved in private equity to gain a consistent exposure and to get returns that are well in excess of what they would achieve in the stock market generally. If you look at if you do just at the last 10 years, the share price total return is about 8 percentage points per annum better each year for 10 years than you could have achieved in the stock market, which is a huge premium. And that doesn't happen by accident. It happens because we've built a high quality, well diversified portfolio, because my team are very experienced in finding these investments. And as long as people are confident that we can continue to do that, we'll keep this company going. Right, I think we are getting quite close. There's one more. I'll just take this last question. If EBITDA is growing mid-teens but NAV is up a few percentage points, does that mean that valuation multiples are revised downwards? Well, there's a little bit of softening of multiples, so that is correct. But the long-term trend is, in terms of NAV growth, will still be upwards. Somebody's asked, how can you attract new investors, especially when stupid rules about total expense ratios are deterring previous investors who see such trusts as dear? I'm aware of the Lord's Private Members Bill. Let's hope it happens. However, more new investors will raise prices and reduce discounts. We are new shareholders, should add, but there are fewer and fewer managers like us out there, it seems. Yeah, I think the way that costs are presented is an issue. I had the discussion with the chief executive of the AIC on this last week, and they and we don't think that the way things are presented is fair, particularly if you add in the fees attributable to underlying funds. It basically just makes us look really expensive. The actual management fees, i.e. the fees that we are paid, are not particularly high. It's not a particularly unreasonable expense when you consider what the returns are. And bear in mind, all the returns I'm talking about are net returns. So that's after all these fees and expenses. I mean, that premium I just mentioned, 8% per annum over 10 years, above the stock market, that's after all these fees and expenses. The bill going through the House of Lords, led by Baroness Altman, is to try and remove, I think, some or all of the requirements of the AIFMD, which was, after all, a piece of European legislation, and to disapply it to investment trusts. Now, those of you who follow this will probably remember that originally the investment trust sector lobbied hard for the AIFMD not to apply to investment trusts, because a lot of the things that were supposedly beneficial from the AIFMD were already being achieved by investment trusts through their independent boards and other things. And so if that legislation goes through, I think it will probably be beneficial. I mean, it may not go through. I think it's difficult for a private member's bill to actually get through, as law, even if it's being piloted by a very experienced person, which in the case of Ros Altman it is. So we'll see what happens. I think there will probably be some movement on those regulations at some point. Somebody said, do you think the returns on new investments are better than the return available buying CTP shares back on the current discount? Now, those of you who've read the RNS will see my detailed views on this. So I think that there is quite a big difference between buying back your own shares and investing into new investments. The principal one being that buying back gives an immediate one-off boost, but you cannot keep doing it because you will basically shrink, and as you shrink your asset base, you've still got commitments, debts, etc., which can increase the risk profile rather of the company, which may actually affect the share price. So a lot of people think that buying back is a way of automatically improving the share price, but it doesn't necessarily work like that. We're trying to maintain long-term returns and a long-term dividend, and we see plenty of opportunities where we can invest the money and make these returns year in, year out. We will buy back when we think it is clearly beneficial for the company. For example, if the share price is being hammered by some loose stock around, and we have done that, historically. In fact, we stood in the market a few weeks ago and were prepared to buy back. In the end, it wasn't actually required, but the price bounced quite strongly on the back of that. We will do that in consultation with our brokers. I think a lot of people have focused on what Pantheon has been doing recently. A couple of fundamental differences between ourselves and Pantheon. The principal one is that they haven't paid a dividend before, whereas we pay 4% per annum out every year. So they've done a moderate-sized buyback, and their discount is still just as wide, I think, as ours is, despite having done that buyback. So I don't think buybacks on their own are a panacea. They have their place, but the whole issue of capital allocation I've actually discussed in my RNS statement, so I think it's fairly clear what my view is on that. Okay, I don't see any other questions coming
Yeah.
up. I think you've covered just about everything.
Perfect. Yeah, I think you actually managed to address all the questions from investors. And of course, the company will review all the questions submitted today and will publish those responses out on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you, Hamish, could I just ask you for a few closing comments?
Yes, we are in a year of transition, but it is not a year of stagnation. Far from it. We expect to make further growth in NAV before the end of the year. The portfolio is proving resilient. It's very well diversified. It's got lots of new companies entering it, and lots of culminating exits are also happening, albeit at slightly lower proportions than in the last year or two. The dividend is very handsome. There's a great opportunity, as I mentioned, to get involved in the shares. Private equity is a long-term asset class. It's one of the most long-term asset classes you can be involved in. It has delivered over the entire 25 years of this company's history, and there's no reason why, if we stick to our process and invest diligently and manage the capital of the company successfully, why we cannot continue to grow well into the future. Thanks very much for the support of all of you. Thanks for your questions, and obviously we're available at any time to elaborate on more of these. And if any of you want to come and see us at our AGM, you'd be more than welcome, which will be in the spring.
Perfect.
Thank you very much, everybody.
Perfect. Hamish, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CT Private Equity Trust PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.